Welcome back to Market on Close. I'm Marley Caden. It's time for Overlooked Stocks. We'll welcome in George Tsilis, our senior markets correspondent here at Schwab Network. Now, George, Credo Technology Group has been on a run so far this year, up 100%, just 428% in the past 12 months. Now, they play a key role with hyperscalers. And as I was looking them up ahead of our conversation, I saw a headline that said Credo obliterated estimates for the fiscal first quarter and for guidance for the current period. Is that what's driving some of these major moves?
Yes, I'll talk about the earnings and the sales numbers, which were reported yesterday for Credo. But this is a company that's just been in the midst of the aspects of AI data centers. It's essentially a company that's a semiconductor company now that's basically provides technologies for optical digital signal processing. So in essence, they are active electronic cable solutions that enhance efficiency of data transfer, but they also help optimize networks and effectively help do so by providing optimization technologies that use low energy. And that's really improving the yield of data transfers and the yield to data centers. And that's very attractive to the hyperscalers, which are providing or investing tremendous amounts of capital expenditure to build out data centers. And so some of the companies that Credo competes with are traditional Ethernet switching companies like Cisco and Aristanet, but there's also an element of application-specific circuitry, which fits in with other names like Broadcom today, which reported yesterday afternoon and had a nice day, and even Marvell, which we've talked about as being a challenged company in this particular segment. But Credo, if you look at it in the last 3 years, it's basically 10x. Tenfold increase. It's really just in the midst of this, AI revolution, hyperscale and data center build out, and they do have a fabless model as well. So they have third-party manufacturer, primarily Taiwan Semiconductor, as well as major hyperscale customers. Amazon was the primary one, but not necessarily the case going forward, because when the company reported their last earnings and sales, they talked about their three biggest hyperscale customers now only represent around 10% of sales, so they don't have a lot of concentration risk like they once did in the past. But nonetheless, if you look at the top line sales the company posted, they're quite phenomenal. 223 million for the quarter, year over year. That was a 275% increase. So that's better than Broadcom, better than Nvidia. While at the same time, they increased the EPS to 52 cents, beating the estimates basically by 16 cents. And one of the things I think that's creating a trend continuation in the name is prior to the guidance revision for fiscal year 2026, they were guiding for about 85% top line sales. But in fact, if you look at what they talked about in the conference call, they actually increased that to 180% for fiscal year 2026 compared to 2025. And just to give you some numbers too, in context of what's been going on, like I said, in the last 3 years, it's basically gone up nearly 1,000%. But in 2020, the company was generating about 54 million in sales. Basically, fast forward in the last 12 months, 600 million. So that's more than tenfold increase in sales. And it's also now gone from losing money back in 5 years ago to making essentially about 125 million of net income on those sales, which is a pretty substantive net income margin, especially for a company that has essentially less than 1 billion in annual sales.
I mean, it's just an incredible growth story here, as you point out the chart and their growth over the past 5 years. And you mentioned their sales year over year surging 275%. I was looking at their earnings, up 1,200% year over year. I can't think of the last time I saw that in any report, let alone tied to a company that is sort of affixed in something we're seeing a boon in right now.
Yeah, very much so. I mean, this is just a classic example of growth, a hyperscale growth company. I mean, at a reasonable price. And it's been growing tremendously. And the other thing you got to consider is, these EPS rate of change numbers are profound. But I also take into consideration financing needs for businesses. And one of the things I noticed about this company is they've increased their total share count in the last 5 years by 150%. And it's actually increased tenfold in terms of return on that equity. So they're well financed and well capitalized using equity. They have just a fraction of debt, about $12 million. It's nothing to speak of. Cash on the balance sheet, close to $480 million. And market capitalization now near 23 billion. So I think it's a situation where this is the company that has the right technology and is catching the wave at the right time, and it's basically growing at a reasonable price. And I say this because if you do consider the expected EBITDA growth on a forward basis at 225%, it's trading at 54 times next year's earnings. So basically, that's suggestive of a PEG ratio that's less than 0.35. And this is probably one of the cheaper technology companies out there. All else equal, it's not a mega cap name, but it is again a name that's growing profoundly. But it's again sort of the situation where it may only be contingent upon the next few years of tremendous capital expenditures. At some point in time, the rate of change in growth in this business will start to decelerate. But again, not necessarily a bad thing as long as they can increase their profit margins over time.
George, we appreciate you breaking all of that down for us and talking about Credo Technology today. That's George Tsilis, our senior markets correspondent.